The Russell 2000 held the market up today like a man pushing a rock up a hill. All right, so in today's video, we're going to take a look at the entire market. We're going to take a look at the S&P 500, the NASDAQ 100, the Russell, the VIX, the dollar, the bonds. We're going to put everything together, and I'm going to give you guys a good understanding of what the next steps are for the market. All right, so without further ado, let's get started with the video. All right, first of all, let's go ahead and take a look at this website. It is the CME Fed Watch tool. This tracks the likelihood of the possibilities of FOMC rate moves. Okay, so for each different month, different meetings. Okay, so for the June meeting, June 14th, so look at this up here. There's a 0% chance that we're going to have a rate cut. There is an 80.5% chance now of no rate hike. And there's only a 19.5% chance of a rate hike. So this primarily is due to the fact that the debt ceiling was increased, that we have some bullish moves in equity, and the Fed doesn't essentially want to create a rate hike. They're aiming to do that for the July meeting. So in the July meeting, if you add these two percentages up, basically, yeah, so this added it up for you. So there's a 65% chance of a rate hike, and there's only a 34% chance of no rate hike. So they're not aiming for any hikes in June. The headlines a few weeks ago when the FOMC minutes came out was that the majority of the Fed wanted no rate hikes for June. And we saw this number fluctuate. We saw this number drop all the way down to, I think, close to 50%. And then it dropped, and then it jumped back up to 80. So the debt ceiling news coming to a close, essentially, and coming to an agreement was very good for this. And we're going to have to look at a rate hike heading into July, not in June. Okay, so that is very, very good for equities. That's good for stocks because there's not going to be a rate hike, which means that no interest rate increase. So no interest rate increase means more money for these companies to make and for them to borrow at cheaper prices. So it's basically good. Cost of everything is going to be cheaper for now. All right, next I want to take a look at the VIX, the dollar, and the bonds. Okay, so right now, this is a daily chart of the VIX, and we know that the VIX has an inverse relationship to the market. If the VIX is falling, that means that the overall market is strong and bullish. Okay, so currently right now, we see the VIX dropped outside of the lower level of the Bollinger Band once more. And we know that the Bollinger Band, basically, it is 2 standard deviations away from the median line, which is the 20 exponential moving average. And if you're trading outside of either of the 2 Bollinger Bands, it is extreme overextension to that direction. So if the VIX is beginning to become overextended to the downside, that is an increased probability that the VIX would need to bounce, right? So if the VIX needs to bounce soon, that is bearish for the stock market. Okay, so the lower we go at this rate of speed, the worse it is for the stock market. So yesterday I was showing how the VIX was trading inside the Bollinger Band, right? I said that we traded inside the Bollinger Band and there would be more room to go to the downside on the VIX. Today was that day. We ended up falling even lower on the VIX. So now, technically, when we're this extended, right, there is more room to go to the downside. But now that we are this extended like this on the VIX, if we get another very big green day or another big drop in the VIX, we're just basically going to have to monitor now if the VIX opens outside of the lower level of the Bollinger Band. That would be much more easier for us to go long on the VIX or essentially go short on the market. Okay, so just try to understand what I'm saying. Like, if the VIX is very, very weak and it's showing a lot of weakness, then that is good for a potential bounce in the VIX, or what that means is a potential drop in the stock market. So it's good for bears, okay? And that's the levels that we're currently at. Okay, there's still more room to the downside though. We're at 14 on the VIX. Basically the last time we were here was back in July of 2021, and then before that we're back in February. Okay, so we are we're seeing levels on the VIX that we haven't seen before the COVID crash. So there is a little bit more room to go to the downside, but so far it's starting to get a bit overextended to the downside. So bulls need to be wary. S&P 500 stock market bulls need to be wary according to the VIX. Okay, next let's take a look at the dollar. So the dollar, it's continuing to show weakness at this level of resistance. We're not getting any clear-cut closes above resistance. Okay, and we know that the dollar has an inverse relationship to the market as well. If the dollar is showing strength, then that means that the overall market is weak. And currently, right, for the past few weeks, the dollar was showing a lot of strength. Cool. But immediately right now, the dollar is failing to break above any major levels of resistance. So this weakness in the dollar is bullish for the overall market. So there's, this is not what bears want to really see. So the VIX is showing that there's more room to go to the downside, right? The dollar is showing lack of weakness. So far, there's two indicators essentially, the dollar and the VIX, that are showing more potential room to the upside for the stock market, pragmatically. Okay, so there's that, right? Basically, what I want to see, what bears want to see. If you're a bear, you want to see the dollar start to close above 104.50. If the dollar can close above 104.50 and specifically above this high here at 104.69, then it should show weakness in the stock market. But for now, we're showing weakness at levels of resistance. All right, so next, I want to take a look at the 30-year bonds. So the 30-year bonds, we know, have a bit more of a correlated relationship to the market. If the bonds are showing strength, that means that the stock market is also showing strength. We see that the bonds are bouncing. They're not showing that much strength here. But support held. We had a big move to the downside. Support held, and we ripped up. So now, essentially, the bonds need to break above. Once again, like I was showing yesterday, the bonds need to break above 128.20, specifically 128.20, for continued move to the upside. It's not immediately looking very, very strong, but it's holding support. We're getting some sort of strength and support out of the bonds. Okay, so now let's have some fun. Let's take a look at the overall indices market. All right, so number one, take a look at the SPY, the QQQ, and the IWM. S&P 500 was only up 0.22% today. The NASDAQ was down 0.02% today. And the IWM was up 2.63%. So the IWM had a huge move to the upside. And that strength in the IWM helped pull the SPY up because the NASDAQ was not helping the SPY. So essentially, look at this big move on the IWM. We are very, very overextended to the upside in terms of the Bollinger Band. Clearly, the Bollinger Band is so look at this. The Bollinger Band is at 182.11. We are over $2 away from the Bollinger Band's upper level. So that is showing extreme overextension to the upside. And what we ended up doing was we hit straight to a level of resistance from this Fibonacci level from December 28th of 2022 to the recent highs of February 2nd. So I took a fib level of that level. And today we ended up hitting the 50% of that Fibonacci retracement, and that held as resistance. So what I currently did was I went short July 23rd puts on the IWM. And the reason for that is, number one, we're very overextended to the upside in terms of the Bollinger Band. And number two, we hit a level of resistance. So we're just going to keep it very simple. If it doesn't work out, it doesn't work out. But now is definitely not the time to go long. And if we continue moving upwards, then I mean it just sets us up for a better short between this zone here, between the 50% zone and the 618%. Oh, sorry, between the 50% and the 38.2% fib level here. So then okay, we'll break above here, and then we'll just go to like 188. So it's not going to be a huge issue. But so far, this is a very high quality short, in my opinion, because we are very overextended. The IWM should not be the biggest winner tomorrow. If anything, it should be a loser heading into tomorrow, because money should be flowing out of the IWM into the NASDAQ and the S&P 500. If this move is sustainable to the upside, that's what's going to end up happening. And I really like this trade because we're basically at a level of resistance and we're very overextended to the upside. So there's that. When taking a look at the NASDAQ, we're not getting a lot of strength. Obviously, the majority of the strength was in the Russell. You can see the NASDAQ held support, right? It held 353. It held 351. We didn't get any sort of a pullback. It was down only 0.2%. So 0.02%, sorry. So barely anything happened today. And we're just holding above support. So in yesterday's video, I was explaining how this is exactly what needed to happen for a continued move to the upside for everything. We needed to see either strength in the Russell and the NASDAQ holding support, or strength in the NASDAQ and the Russell holding support for a continued staircase up in the S&P 500. So currently, you know, the NASDAQ had a very, very dry, nothing sort of day. We can quickly take a look at Apple. Apple released news of a lot of different products that they had. They released a VR headset and some other products. So that caused the market to spike up, and now it's dropping a bit. Nvidia, you know, had a bit of a red day. AMD had a AMD was up big today. Google made another high. Microsoft didn't really do much. Tesla like bounced. It didn't really close above prior high. Meta didn't do too well either. It was basically holding resistance. This is not a bullish setup on Meta. Netflix didn't do well either. And then when we look at Amazon did well because Amazon is also involved. It's a retailer as well. If you look at it that way, it's when the IWM does well, Amazon tends to do well also. So, you know, Amazon did well. Okay, so the main thing now that's left to look at is still based off of this entire big move on the SPY, the NASDAQ. Now we need to see if the NASDAQ can start pulling the SPY up, because the IWM had a 2.5% move to the upside, and the SPY is still holding. The SPY only moved up 0.2%, and the SPY is still holding below this level of resistance. Okay, so there's clear-cut resistance here at 428, 80, 429 area, right? Big move today out of the IWM. It still did not allow the SPY to break above that. We did not break above yesterday's high. We didn't close above anything particular. All we did today on the SPY was we held support and we bounced. So initially, there was only two plays that you could have taken. You either, you know, go short the Russell, or you were going to take, but this would be the riskier trade, you were going to take longs on the NASDAQ. And either of them, they're both high quality trades. If you know you're bullish, regardless of if you're bullish or bearish, those are two high quality trades you could have taken, because you're assuming that the NASDAQ is going to start getting some love, and the NASDAQ would be the biggest winner tomorrow. That's what you're assuming, and that is a good assumption because the Russell had a big win today. The other trade is going short the Russell, because the Russell is very overextended to the upside and there needs to be a bit of a pullback. So either trade is a good trade in my opinion. And the S&P 500, if the NASDAQ can start showing some strength, then the S&P 500 can start to break above this level of resistance. Because we clearly saw the Russell had basically no effect on the SPY. All it did was hold support. If the NASDAQ can start showing some strength, and the NASDAQ has a 1% 1.5% day, then expect the SPY to have at least a 0.7, 0.8% day. And yeah, the levels of resistance remain. Going short the SPY would be a bad trade because you're basically smack dab in the middle. If the Russell shows weakness, the NASDAQ can show strength, which will pull the SPY up. If the NASDAQ shows weakness, the Russell can keep the SPY up, basically, in terms of support. So going short or playing the SPY as a swing would not be the trade to make. You should either be trading, for this situation, in my opinion, you would either be trading the NASDAQ or the Russell. So yeah, just very simple. Very, very simple. So the SPY is at a level of resistance. Not too much strength came out of the NASDAQ stocks. The IWM is at major resistance, had a big move to the upside already. The VIX is very overextended to the downside as well. And, you know, we could see another move to the downside on the VIX. That would coincide with another bullish move on the SPY. But then at that point, you know, it would just set up to be a better short. And if the Russell also gets another high and gaps up, then that is going to be a great, like, opportunity to be short as well, in my opinion. But regardless, I'm bearish on the Russell overnight. And until we break above 429, 430 on the SPY, the only other level of resistance immediately would be this 437.68 level. But aside from that, you know, I hope I did a good job explaining what the next steps are for the market. If you guys enjoyed, please make sure to like, comment, subscribe. I really, really appreciate you guys' love and support. And with that being said, have an amazing day. I will see you guys bright and early tomorrow morning in the live stream. Thank you.